Hello, this is Conrad Invest. Today I'll be talking about 5 stocks that I'm buying in this stock market panic so far. So for the stocks that I'm looking for, I want companies with recurring revenue, I want companies with strong brand recognition, I want companies with low leverage as well, so that in case the credit window shuts, then these companies won't go insolvent. I also want companies that are operating in a monopoly or a duopoly. This is an extremely important one. So the first stock that I bought is Microsoft. Microsoft is currently down around 20% from all-time highs. It is currently trading at around $370 over here. So for Microsoft's valuation, Microsoft is a juggernaut and it is trading at a forward P valuation of around 26 to 27 times. I think it is extremely reasonable for Microsoft because it is a high quality business and it is much higher quality as compared to your S&P 500, which is trading at a similar valuation as well. So for Microsoft's fundamentals over here, as you can see, the ROIC is around 19%. So your normal S&P 500 stock is around 8 to 10% in terms of ROIC. Microsoft is currently at a 20% ROIC. That just shows how much higher quality Microsoft is as compared to other S&P 500 stocks. And Microsoft has around 80% of their revenue, which is recurring, and they have strong brand recognition as well. So your Windows, your Microsoft 365, your Azure, all those portions, they are extremely respected. And so Microsoft over here is currently a business that is trading at a fair value, I would say. So as for Microsoft's margins have been improving over time. So normally when you're looking for companies, you want companies that can improve margins or sustain high margins over time, because that just shows that it has competitive advantage ahead of its peers, and that is what Microsoft has been able to do all these years. It is an extremely multi-business, extremely high moat business, and it is one that you could simply just hold for the next 10 years or so. So, but the problem with Microsoft's story now is that everyone is afraid of this capex spend. But for me, I think Microsoft's capex spend is it can be deployed to all other portions other than Azure. So you have Microsoft 365, which could use some of the AI capex spend as well. You have ChatGPT, you have all the other portions as well under personal computing, which could lead to some sort of capex spend as well. So I'm not too concerned about Microsoft's capex because they have had a history of returning their capex consistently, and so for now, I am bullish on this stock. I'm going to be bullish on this stock in the near future. Hopefully, it drops a lot more so that I can get a lot more of this one. Next stock is ASML. So ASML over here is currently trading at 40% down from all-time highs. It basically touched around $1,100 a few months back, and now it is currently trading at around $660. So for this stock over here, it is just an absolute monopoly. So if you're to just look at this wafer fab equipment portion, ASML is the only company that holds more than 80% market share in its individual segment over here. So if you can see this chart over here, ASML is the largest chunk over here under your patterning portion, and the patterning portion is also the largest chunk out of all your wafer fab equipment portion over here. So for ASML's metric, it is a hardware business that is maintaining gross margins around 51%. It is a hardware business, it's not a software business, and yet it is able to increase its margins over the years. Why is it able to do so? Because it is a monopoly. It is a monopoly in the EV segment. And if you to just look at the ROIC, it is even higher than Microsoft as well, currently around a 26% ROIC. That's what you want for all your different companies, and that's why I remain bullish on ASML. So for ASML's valuation over here, I used the 2025 estimate as well as the 2030 estimate. For the 2030 estimate on the low end, the fair value of the stock is around $515. And for the low estimate for the 2025 benchmark is around $550. So that's around a 10 to 20% downside from here. But if you to just look at the bull case for all your different for the 2025 one as well as the 2030 one, it is a double from here. So for 10% risk, I'm getting double. So it is a decent price now. It is around 10% undervalued, and for a high quality business like ASML, I think it is a decent entry right now. And that's why I've been buying into it. So for ASML over here, there are multiple different tailwinds. So you have your AI growth as well as your semiconductor industry recovering. So the semiconductor industry has been actually on a downturn for the past few years or so, and it only rebounded last year. So we will see around a 15% growth for your semiconductor industry this year if there's no recession. And so I think ASML will definitely be a beneficiary of that as well. So is ASML a compounder? It has recurring revenue. Yes, it does. So ASML has another portion, which is your installed base management. Basically, what they do is they have on-site people to service the machines whenever they go down, and they have people on-site to manage the machines as well. So all your different customers of ASML, like your TSMC, Samsung, Intel, all these companies, they will have to pay ASML to have ASML people in their fabs to maintain the ASML machines. So this portion over here is a recurring revenue stream. It is an extremely predictable one because all these different machines, they last more than 30 years, and that is just recurring revenue that ASML can collect over the span of 30 years. It is a monopoly, yes, because it has 100% market share in the EV sector, 80% market share in the DUV sector. Those two portions are it has extremely high market share. And you have the last portion over here, which is your low leverage. So for ASML over here, it has more cash than debt now. In fact, it has double the cash as compared to its debt. So low leverage, definitely, it can definitely survive any sort of economic environment, and the company has a policy whereby they want more cash than debt. Third stock that I've been buying into is Amazon. So Amazon currently is trading at around $190. I think for Amazon is quite cheap right now because why? So if you're to just look at the ROIC over the past few years for Amazon, even with all this capex spend, has been able to increase its ROIC all these years. And so even with a heavy capex spend and ROIC increasing, this shows that Amazon is able to basically generate returns on all the different capex that they're spending. So even though they're spending $100 billion in capex this year, I don't think it will hurt the company too much. Why? Because capex is not just for AI cloud computing. They have other portions of the business that can benefit from AI capex spend as well. So you have your retail side, you have your third-party seller services, you have your subscription portion, and all your advertising as well, which could benefit from all this AI capex spend. And Amazon itself is the largest customer of AWS, and that's why AWS is still such a high quality business today. So their margins are so thin on all these other businesses like your retail advertising, and if you can use that AI capex spend to increase the margins by just a very small smidge, this stock could easily be a double in 5 years. So for Amazon over here, the margins are exploding on everything else outside of AWS. So AWS is at around a 37% operating margin. And for everything else apart from AWS, it is around 5.4% last year. And it was at around a 2.7% in 2023. So they doubled their margins in just 1 year. And I expect them to continue improving their margins on those portions as well. So AI CapEx spend, as I said earlier, is beyond just the cloud. There are other use cases as well as to improve efficiency of your AI CapEx spend. So for me, Amazon is probably the most multi-Mac 7 business in the stock market today. In fact, I think it is up there with Microsoft in terms of business quality. And yes, although the consumer may weaken, the consumer in the US could weaken, and this would definitely hurt Amazon stock. But for me, I think Amazon will come out stronger like it did in 2020 as well as 2022. Fourth stock is Visa and MasterCard. So Visa and MasterCard over here, it is not down as much as all your different other Mac 7 stocks, and that's why I haven't been adding it to it yet. But I'm hoping that they drop more so that I can add to it. So Visa and MasterCard, they are compounders. Why? Because they have a royalty business. It is sort of like a recurring stream as well. They have low leverage. They have strong brand recognition because they are the only payment providers that is being recognized in the entire globe apart from American Express. And then they operate in sort of like a duopoly as well. Okay, so for these two stocks over here, they have revenue growth that is extremely predictable as well. It is 10 to 12% for these two stocks, even though they are already mature stocks. And if they can have 10 to 12% revenue growth, plus a bit of buybacks here and there, the EPS growth could easily be around 15% for these two stocks. So they are probably the best business model out there. So Visa and MasterCard, they are toll gate businesses. They just collect money as the economy grows. So they don't have any sort of credit risk. They don't have any risk at all. The only risk for them is just regulation as well as consumer risk. But for me, I think this business is one of the highest quality out there, and that's why I'm looking to add into this stock. But the problem with this stock right now is they are currently trading at an extremely high valuation. So MasterCard is trading at a 38 times earnings. Visa is currently trading at around a 34 times earnings. And so for me, I want both stocks. I want MasterCard to be at around 33 times earnings, and I want Visa to be at around 28 times earnings before I load into these two stocks. Last stock is SPGI and Moody's. These two stocks are duopoly as well. So for S&P Global and Moody's, similar to MasterCard and Visa, they are currently trading at around 40 times earnings. So for these two stocks over here, the business quality is extremely high because both businesses, they have large portions of their business coming from the ratings portion, which is just a toll gate business. So what they do is they just rate all the bonds and all the debts that all your company gets, and then they take a percentage of the debt as their revenue. So they have recurring revenue streams as well from the data side of the business, and they are extreme high quality business. I would rank them just slightly below Visa and MasterCard in terms of business quality because they have risk to credit as well. But for them, I think they're extremely high quality business, and that's why Warren Buffett, he owns Moody's. But the problem with these two stocks is simply just the valuation as well. So they're currently trading at around 40 times earnings and approximately around a 30 times price to free cash flow. But over time, it is better to pay for business quality, and that's why I bought into S&P Global a few weeks back at around $480, and I'm hoping that it drops a lot lower so that I can continue adding to it. But for me, I think paying up for business quality is definitely worth it because these are high quality compounding machines that will compound intrinsic value over time. So last portion over here is just temperament. So I know the stock market has been dropping a lot recently, but don't be happy when stocks go up. Don't be sad when stocks go down. Just buy along the way. Of course, you will catch the falling knife as it keeps falling, but all wounds will heal over time. So other than a depression, the stock market goes up most of the time. So we could definitely see a recovery in the near future soon. Maybe give it 1-2 years and we will definitely see all-time highs again. But treat this year as an opportunity to add. Don't view this year as a down year, just treat it as an opportunity for you to add to your positions. And over time, your positions will compound over time. In no time, your portfolio will basically be at all-time highs again, maybe 2 years, 3 years later, unless we go into a recession, unless we go into a deep depression.